Welcome. I'm Catherine Magana here with Steve Wolf, Rachel Ivanovich, and Greg Carroll, where we're here to provide you insights about investing, the markets, and tax planning. So here we are the following week, and the markets have been a little interesting. The Dow is actually down a little bit. The NASDAQ and the S&P are up slightly, mostly the NASDAQ. And small and mid-cap stocks are down. So not a lot's happened since last week, but it does look like there's some new numbers and things that have come out. We do have the numbers for the CPI, which is the Consumer Price Index, which came out for August at 2.5%. So in July it was 2.9. So we are seeing a little shift with some of those numbers. And that obviously ties into inflation and the price of goods. But we're also still, the talk of the town is still the Fed and interest rates, and where is that going to go?
Yeah, it's, excuse me, interesting with the CPI. It's probably, I think, the last data point the Fed gets to see before next week when they have their meeting. And it came out a little hotter, so, people's expectations now are that, maybe it was 25 basis points or 50 basis points next week, but with the hotter data, probably more likely just 25 basis points. But I think, one of the parts of the inflation number that has been sticky is the shelter inflation, housing costs, insurance costs to insure that house. So that part I don't see changing a whole lot. Interest rates have already come down on mortgage rates because everyone knows the Fed's going to lower rates next week. So I don't think that there's going to be much of a change in the near future on the housing front.
I think a lot of the prices are already baked in. We talked about this last week. The surprise would be, in my opinion, if they didn't do anything, or even if they did 50 basis points. I still think that's an outlier, could happen, but the trend is definitely that rates are going to go down. Okay, so you should really be looking at, in any portfolio, what could be advantaged by that. But I want to go back to the inflation that you were talking about. I looked up what the average U.S. inflation rate was, and this is according to the Bureau of Labor Statistics. And I just went back 5 years because that's really what we're talking about. And back in 2020, the inflation rate, average U.S. inflation rate, according to BLS, was 1.2%. Then in 21, it was 4.7, 22 was 8%, 23 was 4.1, and 24 was 3.1. So the reason that this is important is because inflation is insidious. It takes away your purchasing power. So your purchasing power during the last 3.5 years is down by 121.36%. I'm sorry, 21.36%. And that means that each dollar that you have in your pocket is only worth $78.64 versus the amount you could purchase just 3 or 4 years ago. That's a real problem, and that's why the Fed has really been very, very cautious about what they're doing. They've almost wanted to put us into a recession. And finally, it's happening where, I don't know if we're going to go into a recession or not, but definitely things are slowing down. The other thing I looked at, and we talked a little bit prior to this taping, was food inflation. Food inflation, again, this is over the last 4 years, is up 21.5%. And that's a lot. In 21, it was 6.3, 22, 10.4, 23, 2.7, and this year so far it's up 2.1. Again, this means that your purchasing power is gone down by about 23.05%, or make it a different way, if you had $100 4 years ago, it's worth only about $76.95 in purchasing power today. So you'd need about $123 to buy the same things. And I know, Catherine, you were talking about some individual things. And this is, before you get to that, this is what we're really talking about with individual people. The numbers that you're going to tell us are things that really affect them. These are everyday goods that are going up by a lot, that have gone up by a lot. Go ahead.
And so we were discussing that eggs saw a surge, so it's actually up 4.8% in August compared to July. But from a year ago, eggs are up 28.1%. So that's kind of a household.
Still cheaper than having chickens.
Well, there you go. But
I just give them for my neighbor's chickens.
Okay.
So,
but you have an
Best of
unlimited
both worlds.
But you have an unlimited supply with chickens.
Maybe. It really depends. Sometimes they get a little finicky.
The input costs are eroding that, I think, is what she's saying.
Well, if they get really finicky, we just eat them. So,
And then we were talking about the price of used cars. So it did slow down 1% in August, and then it slowed down to 2.3% in July. But the index for used cars slowed down almost 11% year over year. So we are seeing a slowdown in some spending, and then
and used car prices had skyrocketed
Yeah.
over a couple of years ago. You could get a lot of money for your used car. You still can probably get that, just not quite as much.
And then auto insurance was up 16.5% since last August.
I don't know about you, but when I
Mine
opened
went more. I think mine was up like 50%.
Yeah.
when I
Here in
opened
California.
Sounds like a small increase.
when I opened my new expense for auto insurance, I just about died.
Yeah.
So
Although I'm going to share an expense that went down. So cell phones were down more than 8% year over year. So that's kind of interesting that cost didn't go up. But I think for the most part, I think a lot of us feel the price of food and gas and then restaurants, the cost, the restaurants
yes.
eating away from home,
That's
that
it.
rose 4%.
in what time frame?
So that rose 4% annually over the food inflation, which was up 2.1%. So over the last year.
I don't know. I've done this over the past several months about my fast food inflation, and I'm telling you that if you went out for a McDonald's, at least around here, for a quarter pounder with cheese, fries, and a drink, about 4 years ago, the price was around $8.5. Today, you're paying between $12 and $13 around here. That is a big increase, and for people on the lower end, especially of the scale, they're having trouble. They're having trouble making ends meet. So that's why it's important for the Fed to do what they're doing, and to get that rate down. So hopefully wages can catch up. I don't have the statistics here, so I'm guessing that wages haven't kept up, which is why people are having trouble, especially in the housing market. The price of houses have just skyrocketed.
Yeah, there's just not enough supply. And even though interest rates and mortgage rates have gone up, there's just not enough supply.
Exactly. And there's not enough supply because I think mortgage rates have gone up, and because people locked in 2% and 3% mortgage rates.
They don't love the house, but they love the rate.
Exactly.
Yeah.
Well, we just haven't built nearly enough houses over the last 15 years since the financial crisis. And a lot of that has to do with regulations that are in place, and it's making it harder for builders to actually buy the land, set it up, be able to put these new housing developments together, or even multifamily complexes.
And it's so much more to build these days.
Oh, yes.
We got a bid, and it doubled over the last 2 years
You got a bid for...
to build a home.
It
Wow.
doubled.
The price of lumber has doubled and tripled.
Right. I think that price is starting to come down right now. So, and again, all prices are starting to come down right now, and it's because the Fed has been, almost insidious in how quickly they raise prices. And I think it was because they were behind the curve. And I don't think they want to be behind the curve again.
So Social Security looks like for 2025 that we're looking at an adjustment at 2.5%, which is the lowest it's been in a while. And the reason why we look at inflation and the cost of goods and why we talk about this is really tied to financial planning. When we look at your financial and retirement plan, we do some projections in our planning to make sure that we're factoring in inflation for how much money you need and also for Social Security. So this is why it's important is because it does tie into your overall financial plan and investments. And so this is an important part to factor in and not something to get overlooked.
It's kind of that blind spot in that, that people don't think about hey, I make this much money, I've got this much saved, but they don't see what that erosion of the inflation does over the next 30 years of being retired. It's huge.
That's why I think when you do the financial plans and you actually see the number that you'll need, so, instead of saying...
Today's dollar versus future.
Right, today's dollars versus future dollars, where, my $100 buys X, you might need $200 to buy the same thing. So it's so important to make sure that your portfolios are going up at least at the rate of inflation, and that it should be after tax. So, and I know speaking of tax,
Yeah, so it's time to plan for next year, and let's keep your CPA happy. So get your financial. Honestly,
Why?
because it'll keep the price of your tax return down. Because the inflation, think about it. When I started doing taxes, you charge $50 for a tax return, and now we're charging $1,000 for a tax return. But there are ways to keep the price of your return down, and that is be organized, and part of that is starting early. And I think. We're almost in the fourth quarter. Third quarter estimates are due on Monday. So if you haven't yet paid your estimated payments for 2024 for the third quarter, they are due. Still have time to calculate those. Kids went back to school, grandkids went back to school. So guess what? It's time to clean out your garage, clean out the attic, get rid of the things you don't need, keep the slips so you can write those deductions off. And
I thought it was time to get some sleep.
we are not done yet. October 15th is about 6 weeks away. We still got a little bit of time, or 4 weeks away. So definitely, if you haven't filed your taxes for 2023, make sure you get those in. I know a lot of clients that have investments or partnerships. They're just getting their K1s. K1s for those partnerships are due on Monday. So it's time to wrap up 23 and do your planning for 24, but do it early. Call the tax office, make your appointment for next season. Your tax person will be very happy with you.
Is there some day, like Accountant's Day, like there's Grandparents' Day?
There should be. It's October, 18th. So don't call on the 15th of October and talk to your tax person. They will not be happy with you. Bring them coffee.
And exactly, I was going to say, what you should do is bring them coffee.
They'll give you a discount next year.
And painkillers, aspirin, something, and also no-dose.
I like it.
I'm curious, how many hours a day does the average accountant work during that really busy tax season?
So from about January 15th through April 15th, you work about 16 to 18 hours a day. You don't get a day off for that entire period. 16 to 18 hours a day. Wow. It's brutal. Yeah. It's not for the weak of heart. Couple hours less than what we work, but so one thing
on an annual basis.
One of the things I think is really important, though, and I see this a lot on tax returns when I take over for a new client, is there are underpayment penalties on that return, and those are completely avoidable. So make sure you're calculating your safe harbors. If you haven't done that yet with your tax advisor, it's really easy to do. You just look at your total tax line, and you pay in at least that much the next year. But call us. Happy to help. This is for estimated taxes? This is for estimated taxes. There are multiple penalties with IRS, and one of those is called the underpayment penalty, and it's completely avoidable. Yeah, and you don't want to get penalties by the IRS because, if you thought you were getting a bad deal with a gangster or a mobster, the IRS is worse. Yeah, yes. And they can come in and they can take whatever they want. They absolutely can, and so can the state. I love the government. All right, well, I think that wraps it up for this week, and we'll see you again next week. Thanks for listening.
All right, thank you.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.